is no joke. I have heard where I had a client actually go to U-Haul, went to buy the insurance, and the lady at U-Haul told her, "You don't need it. It's a scam. Automatically, your auto policy will cover it." Right? Because anytime you rent a vehicle, auto policy will cover that. But a U-Haul is considered a commercial vehicle. A commercial vehicle, unless the U-Haul is a pickup truck. Right? If it's a pickup truck, it's okay. But if it's an actual box truck, there is no coverage. Pay the $95, get yourself insured, because not only will your auto policy exclude the liability, it will exclude the physical damage to that vehicle. All right?
Good to know.
You're not covered in that.
Not
Yep.
covered.
I've just been looking at that stuff, but I think insurance is like.
Yeah, sometimes $95 will be for the 3 days, right?
Yeah.
Yeah, and Mike, I could just scroll, right?
And
Yeah.
I had them say, well, it's due with a credit card, that'll cover.
Well, yeah, it depends what your limit is, right? Your credit card could be the insurance company.
But there's some credit cards
Well,
like maybe American Express, yeah, I think that's like the things that are covered that.
not that I've heard of. I always recommend buy the insurance from these carriers. Even no joke, even at Enterprise, right? When you rent a vehicle, the advantage of actually buying the insurance at Enterprise is if you are involved in an accident and you are at fault, they don't report it. So because they don't report it, it will not count as an at-fault accident. That's a real good caveat on why to buy insurance but nevertheless, anywhere you travel, even to Puerto Rico or Hawaii.
If there's an accident and there's the police coming in, if we get police report, they won't report it.
From what I've been told, they don't report it to the insurance company. They don't send the report to the DMV.
Yeah, but there's gonna be a police report from the CHP or whatever, by the agency, that there was a big accident and it closed the freeway down and
Yeah,
there was
I mean-
one fatality.
I'm sure in a situation like that, it might defer. That one's probably a question. That's a question. Yeah, that's a question for the enterprise guy. That one's a good question for the enterprise guy.
I was like, Andy, I worked for Enterprise. We did not report it. You guys finish paying your rental and you walk away scot-free.
She worked with it,
Yeah,
and that's
that's it.
awesome.
Thank you so much. See how home warranty and how homeowners insurance always a perfect pair, right?
You know what? I will say this, Andy. I don't like that you're talking about me though. I didn't have an accident with a U-Haul. You should take Rebecca off of that little scenario. No, I'm just kidding.
I didn't even think of it. Yes, I just gave random names. Not saying anything personal. Disclaimer. All right, next example. All right. Anyone have any more questions on the last one? All right, here's a good one to know. Al's neighbor John has a 2001 Toyota Tundra. Since Al doesn't have a pickup truck, he frequently borrows John's truck to run errands. He only uses it when he takes items back and forth from his storage unit and at times when he needs to pick up items from Home Depot. In one of these trips, Al gets into an at-fault accident in John's vehicle. He learns that John's insurance policy had just canceled as his neighbor forgot to pay the last month's payment. However, Al has an active auto policy with Farmers Insurance, which covers his personal vehicles. Will Al's auto policy cover him in the accident? So does everyone understand the scenario? Right? I have an auto policy. I borrow my neighbor's truck, which I frequently use, right? I get into an accident and it turns out my neighbor's truck wasn't insured. Will my auto policy extend to my neighbor's truck?
Yeah.
Okay, I hear a lot of yeses, right? See, thank goodness I'm up here, right? Because the answer is actually no. There's a few reasons why.
The owner of the vehicle.
Owner of vehicle is always primary, right? If it's a frequent use, that makes you frequently able to drive another vehicle. That means you have to, on your own personal auto policy, you've never been told this, but there's an actual coverage. If you are frequently using someone else's car, there's a coverage you can purchase that's called drive other car. That's the name of the coverage, drive other car. Automatically, when you have that coverage, I mean, and it's sold as either a liability standpoint or a comp and collision standpoint, right? Drive other car. But automatically, when you have that coverage, now that extends to any car you borrow or use. The only one and only time where actually your coverage extends to another vehicle is when you rent it. When you rent it, but when you borrow it, you need to have that drive other car.
How can they prove that you?
I mean, well, if it's your neighbor's car and you have access to it, that's one of the ways.
What if you rent it from your neighbor?
Well, you gotta, that's, you know, you gotta figure out how to get the paperwork in, but that could be maybe a way to get
You
around
rent
it.
it for $1.
What if your son borrows
gonna-
your car?
Excuse me,
If your son at home borrows your car?
your car and your son lives with you and he's not listed on the policy. Depending on the carrier, right? So sometimes real good carriers might give you an exception and pay it and then force you to rate or exclude. But the truth, most carriers will deny that claim. And the reason why they'll deny it is because on the, you know, the package that they send you that no one reads, in there it states that every household member that has a license or just any household member has to be rated or excluded on a policy.
You said rated, like,
Rated, rated as a
or-
driver, excluded. Rated or excluded. And then here's a key, here's a fact, right? Because sometimes your kid goes off to college, right? And so a lot of clients call me, hey, my kid's off to college, he's no longer driving any of my vehicles, so we exclude him, right?
And then they come home.
Or no, they borrow a friend's car out there and they get into an accident. Turns out the friend's car wasn't injured, right? That's where possibly excluding a driver can be an issue. Cool. So any questions on this one, right? All right, let's do a fun one, a home one. Okay, so after months of searching, Susie and her husband Alex finally closed escrow on a home for their growing family. Oh, sorry. Upon closing escrow, they secured a premier homeowners policy from a well-known carrier. Prior to moving in, they decide on making minor improvements by changing the floors. I brought this example because think about it. How many of our clients actually before ever moving in, they make minor improvements, right? They decide to just change the floors, update 2 of the 3 bathrooms, and repaint the interiors. Because of the scope of the work being minor, their contractor, Jorge, promised them they'd be moved in within 30 days. During this time, Alex and Susie began moving their furniture, electronics, appliances, boxes of clothes, and personal items into the garage where it was secured by deadbolts. Because of delayed material, they were now 60 days into construction and had not yet moved in. On day 64, during the middle of the night, they broke into the garage and stole many of the items that were being stored there. Will the homeowner's policy purchase cover the items stolen? And the policy does cover theft. Homeowners covers theft.
No. Is there a time limit on vacant?
Exactly, yes. This is super important to know because a lot of people, right, the close of escrow, sometimes they get a policy referred to them and no one knows about the vacancy happening. So I've had a lot of situations where items like this have occurred and we've had to tell them no. Every company is different. Some companies go 30 days vacancy exclusion, farmers go 60 days vacancy exclusion. Other companies do reduction of coverage after 30 days, meaning they will pay only 40% of the total loss. So if there was
Question, if somebody moves out of his house, they live there for 20 years, and they move out because they're doing remodeling, and they stay out for 3 months. what
that
happens?
that could be an excluded claim if the loss happens after 60
Can the
days.
homeowner do anything to make sure that they're covered?
Yes.
Construction is-
Yes, two types of insurance, depending on the scope of work, right? You can either get a builder's risk policy or you change it to a vacant policy. Because I have vacant policies, which is typically what I sell to most investors, right, that are doing quick flips. They're just rehabbing the interior, changing floors, changing plank, bathroom, kitchen, right? That's it, kind of minor. Situations like that, a vacant product would actually extend the coverage to it,
You think vacancy policy?
a vacancy policy. And that's important too, because if you're working with investors, I've seen
Are
so
those
many
expensive?
investors, it does, because of the increased exposure, right? Because more losses tend to happen on vacant homes, right? It is a little bit more expensive, but I mean, I've had lots of investors that I've worked with and I know that the house is gonna be vacant for at least 6 months. They want me to offer a basic landlord policy because we're talking $400 as opposed to $1,500, right? But the way I always tell them is like, I wouldn't do it because why am I gonna sell you something that's gonna have no coverage?
Exactly. And
Why
then
give you a
there's
piece of paper and me later deal with potential E&O claim, right? So it's one of those situations that make sure your investors are aware, they gotta have it properly insured. If they're building, adding square footage, builder's risks are typically recommended.
the moral of the story is to live in your house while it's being remodeled.
Yeah, limit it or make the correct changes on the insurance policy. Make them aware, because like I said, a lot of clients don't know this. And
Less than 60 days.
yeah, because they estimate they're gonna be in within 30 days and everything's taking longer than expected. So now they're in a situation where they technically are out of the house. They're still paying their mortgage, but they technically have no insurance.
So if you sit and you get that vacancy policy, does that reduce any kind of coverage that your normal homeowner?
Typically vacant policies limit theft, right? But there's always something in the market to actually meet the exposure. It's just obviously the premium is gonna be determined on how much exposure it's gonna be.
So on a builder's risk, let's say there's a worker that gets rid of the property while they are doing construction, does that cover that?
So that's a real good question. Yeah, in most cases, we do not cover workers. With your contractor. That is why a lot of people save money, quote unquote, going with someone that's not licensed, right? But yeah, you're taking a bigger risk. That's what the money you're saving. You're taking a bigger risk. Reason why sometimes a general contractor that's fully licensed and bonded and insured costs more is because they're paying a lot for their insurances, right? And they factor that in to the cost of their work. Tomorrow, one of their workers gets injured. Now that contractor has the workers' comp. It's gonna, that's gonna admit you. And how you protect yourself is you actually have to ask your contractor, showing proof of workers' comp, naming you as an additional insured. Without that, there's no guarantee you can be named in any lawsuit as a property owner. There are some policies that cover workers' comp, but they're limited. Usually they're more for a handyman scope of work.
Okay, so now that we have all these SIPs in place, which means seller in possession after the close of escrow, okay? We have a lot of 30 days. We have some that are lasting 60 days or more. So I'm the buyer. I let the seller live in my house for 64 days. Let's just use your example. Am I covered as a homeowner if I got a homeowner's policy? Because obviously when
No.
they're purchasing and closing escrow, they're getting a homeowner's policy. But then there's an instruction that says, oh, the seller's gonna remain in the property for 64 days.
Okay, so if you have a company like Farmers and State Farm, they might overlook the situation, still provide coverage, right? But in most cases, they do have the opportunity to kind of deny that claim because you didn't adequately, you're not,
How would you remedy?
they're not rating the right exposure, right? What I would recommend is because I have many of those situations
There's a
happening,
lot of
right?
them, yeah.
We typically recommend two things, either obviously recommend the homeowners get a landlord policy for the month, 2 months, right? And then change it to homeowners when they move in. But in most cases, have the seller force the buyer to have a renter's insurance with a minimum of 100 or 300,000 of liability, and make sure that the new homeowner, the purchaser, is listed as a named insured on the policy. So God forbid something happens, they vandalize the property, now they have a policy that they could subrogate against.
So on a renter's policy, so let's say this seller who's remaining in the property, let's say there's a massive plumbing leak. Does the renter's policy cover that
No.
plumbing leak? No, right?
Unless it was negligence on the renter's behalf,
Like what, they
Put
let
an
the
axe
water
through
running
it?
forever?
something like that.
Because I had someone who called me and the landlord wanted the renter to have a renter's policy in case there was any damage to the property, like a water leak or something. And I wasn't sure which part was covered.
Yeah, it wouldn't, if there was an actual loss on the property, like a water leak, that's now the new homeowner's responsibility.
If you own that home, you don't live there, it's not covered, but you don't live there, you're covered if something
Wait,
happens.
repeat that?
You don't live there. If you have insurance, insurance, are you covered if something happens? If you don't live.
Are you renting it?
Yeah, there's a lot of,
You have, just have,
yeah, it's a lot of open, I guess it's a real broad question, so there could be a lot of variables within it. Meaning, yeah, if you have the property rightly insured, right, if you don't live there, you're renting it, you have a land,
you're not renting.
you're not
You're
renting,
vacant.
then you need a vacant policy. You need to have a vacant policy.
What the cabin?
There's
No.
secondary, then should be a secondary one. There are secondary that do omit vacants, like secondary policy.
So if something happens while, without having the policy,
Excuse me?
if something happens and you don't have the secondary policy,
if
It
you don't have
depends.
insurance.
Yeah,
You don't have
it could be
insurance, you got
depending on that insurance company. Like farmers, if it's been vacant for more than 60 days, they may not cover it. And it kind of going into that, someone has, short-term rentals, right? Short-term rentals are also key, not covered under most landlord policies. You need to have a short-term rental program.
Move in for 2 weeks.
Yeah, typically a landlord policy requires a minimum of 6 months or a year term.
Quick question, kind of going back to this scenario. So if the, let's say that we close this, right? On a home, an owner or a home, and they haven't moved in, yet, they're gonna move in 2 weeks because they need, they're leaving their apartment, right? They want to get it. And then there's a leak and they don't realize that the whole house floods. Are they covered?
Typically, it has to be, leaks are very questionable, right? Typically comes down to the discretion of the claim adjuster. Typically, the verbiage that covers it, it has to be sudden and accidental. So if it's a sudden and accidental discharge of water like the piper, then typically, yeah, something like that's covered. But now let me give you another example. There's a leak that they didn't notice that was happening from their garbage disposal, right? There's a drip leak. Since they decided to wait 3 weeks to get into that house, by the time they get to it, open their kitchen cabinets, the cabinets within are pretty much rotted out and moldy. That could be excluded. So that's why it's important to at least be maintaining and be on top of it.
What
Because insurance companies don't cover small leaks.
What if it was 3 months down the line, like they didn't move in 3 months?
They'll go into that
They
vacancy.
could go into that scenario.
So even if it was a covered loss, potentially it may not be covered.
After 30 days, right?
Usually I would like to say 30 days. Some companies like us, we go 60 days, right? All right, Sergio, I thought of you for this one.
I did, yeah.
No, just kidding. All right, after being laid off from work, Sergio decides to drive for Lyft and Uber.
God damn it. Michael, you fired.
Sergio keeps his personal auto policy active, which is both comprehensive and collision, which has both, it's full coverage, right? However, never notifies his insurance carrier of his rideshare exposure. He doesn't call and say, hey, I'm driving for Uber or Lyft, right? Because he's told, and every time I've hopped into an Uber or Lyft, I always ask this question. They all feel that they have a master policy that takes care of them, okay? While having the app on, waiting for, and this is important in case you have clients that are using Uber or Lyft. While having the app on, waiting for a ride request, Sergio is distracted by his phone, rear ends another car, whose insurance will cover the liability in the accident and the damage to Sergio's car. Would it be Uber's policy or would it be Sergio's policy? Yeah, none. No one. So there's just to explain the scenario on the Uber, right? There's 3 different phases. Okay. There's the phase 1 where they need to purchase the Uber endorsement or the rideshare endorsement from their insurance company. Not everyone offers it, right? But we offer it. Mercury is now offering it. I think State Farm just started offering it, right? But there's a rideshare endorsement. The phase 1 is when the driver has the app on and is looking for work, right? The minute that app is on, technically considered commercial use. I've had many of our clients hit by other drivers and they're forced to use our insurance because the other's insurance company is declining the claim because of it, because they had their app on. Simple as having the app. The minute the app is off, yeah, then technically personal auto policy covers. So then there's phase 1, app is on. Phase 2 is I land a job. Now I'm headed to drive to pick someone up. During phase 2, this is where Uber and Lyft pick up coverage. However, it's limited. Maximum liability is $50,000 per person, $100,000 per accident, $25,000 of property damage. So I personally feel, given today's society, it's a little underinsured. This is where having the rideshare endorsement kicks in. Because another thing is through Uber has at least $1,000 comp and collision deductible. Lyft uses a $2,500 deductible. So another benefit of having that rideshare endorsement, it kicks in. Now, phase 3, we're the client, we hop into the Uber driver, right? Now all of a sudden Uber has $1 million liability, right? And they'll cover the full damage of the vehicle.
So if there's an accident while Sergio is driving along his
Yeah.
customers, then it's way better.
And if ever there's an issue, right, where the Lyft is not picking up in phase 2, your primary insurance will pick up. So that's why I always make sure anyone that's driving for Lyft and Uber, this is just because I know I have a lot of clients that do it part-time, right? Make sure they add, and make sure they're educated to add that endorsement to their auto policy.
I have to go drive this. They call them.
All right, next one.
Don't take our license for.
All right, this one's Gilbert's wife, Melody, loves going to Tijuana to get cosmetic work done. Because of this, they take frequent trips across the border. Prior to his first trip, Gilbert calls his farmer's agent, Juan, not Andy, Juan, right? To ask if he needed additional coverage when crossing the border. After Juan confirmed Gilbert's destination, he tells him, "Don't worry, my friend. Our policy covers you 50 miles into the border." Yep. He's back. He's back in TJ as Melody's ready for new lips when he misses a stop sign and collides against another car. Will his auto policy cover the accident?
Is he 50 miles from the border?
Yeah,
In
within
TJ?
50, in
He's
TJ,
still in-
within
that
50
bit,
miles.
Not 51, not 52.
Farmers used to actually offer 75 miles into the border, but now they've reduced that to 50 miles. So, will the auto
I know
policy,
it's a trick question.
so
I'm
farmers
trying to figure out
insurance.
the trick.
within 50 miles, the accident get covered? And remember, it was a verbal conversation. It's a no, yeah. This is a surprise to everybody because I know how many of us, even including myself in the past, has actually crossed the border into TJ, thinking that my auto policy covers me 50 miles into Mexico, right? Which it does cover the physical damage of the vehicle. So tomorrow you get into an accident within 50 miles of the border, right? As long as I have full coverage, we will cover the physical damage of the vehicle.
To your own car.
Yes, but not the liability to the third party. And in Mexico, if you don't have the money to pay it right then and there, it's a crime. You go to
And then
jail.
you go to jail.
You go to jail. So there's border solution options. They're online. I mean, I offer them, but typically we have to have the auto policy insured, and then we have to go through a third party company. It's easier and cheaper. You just Google it online, right? Border coverage. You can purchase it yourself. It's super inexpensive, right? Because technically, if you're just gonna go to TJ and you know your primary insurance policy is gonna cover the physical damage, you just need to buy the third party coverage. The third party coverage is super inexpensive. Okay, so that's a real important to know because even me, when I first started selling insurance, I was that one.
You were one?
That was one.
One is the lowest
Thank goodness
number.
nothing ever happened. And the reason why I said verbal conversation, right? Just a trick. Technically, if you have an email from an insurance agent, right? And the insurance agent's telling you there is going to be coverage, his E&O will cover it. So tip of the trade, try anytime you have dealing with coverage questions, it's always best to get it written. Me personally, you guys email me, I'm going to call you back with an answer.
Smart guy.
Start recording anytime.
Yeah, this is being recorded, right?
Yeah. We'll edit that out.
Yeah. All right. Ray's homeowners policy covers theft and has an unscheduled content limit of 245,000. Ray owns multiple units and at the first of every month goes out to collect his rent, most of it which is paid to him in cash. After collecting almost 8,000 in cash, he stops at a gas station for gas where he's approached by a man with a gun. To de-escalate the situation, Ray complies with the robber's request by handing him his cash, a gold watch worth $6,000, and a necklace worth $2,500. After filing a claim, how much is paid to him by the homeowner's policy? Remember, there's a 245,000 unscheduled limit. We have 8,000 in cash gone. We have 6,000 in a watch gone and 2,500 in a necklace.
I don't think
So,
he gets anything. for the jewelry.
Roughly 14, 16, 16.5 lost.
I don't think.
How
he
much
gets-
gets paid in that?
I don't think he gets anything for the jewelry, but I don't know what the cash limit is.
Okay, so you said zero, right? There's not a zero answer. There's actually some coverage here.
So
Okay,
is it 5,000
For the
plus
cash?
for the cash plus the rest?
yeah, so cash, depending on the policy, Farmers has two different types of policies. We have a next gen, which is our premier, and we have a smart plan home, which is their standard. We cover $250 of cash on our premier, and we cover 150 on our smart plan home
150 what?
for dollars.
Standard.
Max.
Usually
Max.
standard is 100.
Do not put money under the mattress. Every theft claim I have, they don't really steal much other than jewelry. and cash.
And the jewelry, you have to itemize it, right? in order to be
Exactly.
covered,
So-
Because that's the limited amount.
So our next gen policy, which is our premier, covers 5,000 in jewelry. However, it's it's a maximum of $1,000 per item. So we'll cover 5 items at 1,000 max. So in this situation, we got 1,000, 2,000, $250, and then there's a deductible, right? And then there's a deductible. So Ray almost gets nothing, right? One of the cool thing about farmers, I think we're the only carrier that does this, right? This is where I take pride sometimes in farmers. When we've had clients that actually have had their cars broken into while they're at the gym and they have cash, we apply the cash. So in this example, right, the way farmers would pay it, not and so the way farmers would pay it was, let's say out of that, let's say the deductible is 2,500, but they'll take some of this cash into that deductible. So technically now instead of getting what was it I first gave you, 22,250 minus the deductible, you actually get 2,250. Okay. The smart plan home with us, which is our basic option, covers a max of $2,500 in jewelry, but same thing, max per item 1,000. Jewelry to be scheduled, right, is anything between 1,000 and 5,000 needs a receipt. Anything 5,000 to 10,000 needs an appraisal. Anything 10,000 and more, the appraisal has to be within 3 years of age. Same thing goes with more items that are limited, right? Weapons I know is capped on our policy by $2,000. Fine art, same thing, right? $2,500, max 1,000 per item. Furs, you have expensive rugs. Those are items that are typically need. Bonds, stocks, valuable papers, also limited, almost like cash, almost no coverage to it.
And if you don't have a receipt, if you have a jewelry, then you have it forever, you don't have a receipt.
I mean, the good thing, depending on the company,
get it
right?
for
Yeah, you have pictures too. If you have pictures of yourself wearing the jewelry, they can go based off pictures. But also, you can also go based off pictures of items that you have. So borrow all the fancy purses and just take pictures with them. That's also not recorded.
The limit on artwork again?
Limit on artwork, depending on the policy, I think it's also 5,000 to 2,500 bucks. Max per item, 1,000
1,000
per item.
They don't mind the artwork.
They gotta be appraised,
If it's only worth $1,000, it ain't artwork.
and they could be scheduled.
Oh, sure.
I do have a question.
Go for it.
It says unscheduled. Is that a fancy way for accident?
So if you notice, right, your policy, a homeowner's policy has an unscheduled limit, right? An unscheduled limit, the way it's typically calculated, it's depending on the policy, our next gen is 75% of the structure limit. So if we have 600,000 of structure, it'll be 75% of that will give us the unscheduled personal property amount. Tomorrow, a total loss happens, just as an example, fire happens, right? We have up to, in that example, that person would have up to 245,000 of unscheduled items. All unscheduled items could be all your clothes. Back when I was saying purses, there's no limits on purses. Shoes, right? I mean, I'm mentioning shoes in case, you have a lot of money in shoes, yeah. Miscellaneous, furniture, electronics, TVs. Another item that is limited is business property. Because now that a lot of people are working from home, there is a limit on the business property depending on the type of policy, right? But going back to the unscheduled, yeah, and I'm back to it. You don't even need, yeah, they're gonna ask for receipts, but farmers, another thing, preaching on farmers, because I do think when it comes to claims, they do a great job. When we had the big Santa Rosa and Paradise fires, we automatically maxed out the unscheduled property to all of our victims of wildfires. While other companies are sitting them, asking them for receipts on their house that just got burned, right? Or try and have them itemize a list of doing all this extra work. You would have to itemize it, right, individually to get up to that value. We just automatically gave every client that was a victim to the total loss in the wildfire their full unscheduled limit, which I think we were the only ones to do that. So that's something kind of cool about it. All right, Greg purchased an investor-owned home. I think everyone here is very aware of the investor-owned homes, right? Which appeared to be fully remodeled as it was cosmetically upgraded. Though the roof looked a bit aged, the home inspector noted no real concerns, so Greg proceeded with the purchase. In Greg's first year of residence, there were many times it rained, but never did Greg notice any leaks until a big storm where it rained for 3 consecutive days. Out of nowhere, water was dripping from the ceiling and running down the walls. Greg called his home warranty company and they sent a licensed roofer to complete the repairs and learned that the damage was much worse than he thought. It was evident the leak had been ongoing as the roofer found mold, rotted framing, sheathing, destroyed insulation. The repair, which he thought was only going to cost a few $100s, was now going to cost thousands. He purchased a good homeowner's policy, so he filed a claim. How did the insurance company cover this claim? Pre-existing, well, we could say it got worse over time, but that's a good point. Yeah, pre-existing
Well, that was at the home warranty.
Wait,
company.
is a site. That's good. That's a good point, though. What Gabe said, pre-existing is actually an exclusion.
That's what he's trying to say, right?
Yeah, but but the real truth, if you notice from the beginning, I said the roof looked aged. The number one exclusion is actually wear and tear. This roof would have been excluded. That claim would be excluded due to wear and tear. In order for us to cover, and this is no joke, we haven't had any rain, but every rainy season, and I'm sure you guys just sold a home, right? It rains, roof leaks, you guys are the first ones getting called, right? Same here. I'm getting tons of calls days after rain. Hey, my roof is leaking. Can you guys send someone up to patch my roof, right? There is no rain cover. There is nowhere. So in order for us to cover the damage of water coming into a roof, it has to be due to a covered loss. A covered loss would be lightning, for example, right? Lightning strikes. Wind,
Like last night.
like last night, shingles blow off, rain seeps in through the roof. That's covered claim. However, it's an aged roof. The roof already looks worn. Wind blows it off. The insurance company can say, hey, it's actually the only reason why the shingles blew off is because the roof was already in bad shape. So because of wear and tear, we're excluding the claim.
So do you only cover brand new roof?
Pretty much. We're typically like when rain comes into it, there's usually no coverage. Unless a better example, obviously a tree falls on it, and then we have a hole. Now there's a bunch of rain damage. That would be obviously something covered.
Did you cover the tree?
Yeah,
falling?
tree
And
fall. I mean,
you
we've
would
seen
fix that
hail,
damage?
different states we cover. I mean, in other states, I know farmers is notorious for replacing roofs in Texas, right? Because it hails a lot out there. But hail's a covered loss. So just know that. That's good to know because that's why I typically always recommend people to buy the home warranty and buy the extra coverage. And at least there's going to be some repairs done. However, in a situation like this, right, it's bittersweet, but I've had a lot of these happen, especially in investor-owned homes. House look beautiful, the roof look horrible.
So that's why insurance companies in general, when it comes to roof, are always all over you, like, or even say, hey, we can't cover it sometimes.
Because they don't want a bad claim experience.
That's right, because they drive by and they say,
You're
oh
right.
my God, the tree is on the roof, cut the roof. No
Yeah.
other company does.
They don't
it.
wanna
The
be-
AAA does that all the time.
Yeah.
Cut the tree.
Farmers, yeah, because I've worked with product team trying to even get us to apply a roof exclusion, which is just we'll cover it only for fire and lightning. Because I have other carriers that do that, right? When I see a bad roof, that's why I use a different company other than farmers. But companies like farmers really don't want to have a bad claim experience. They'd rather have a positive claim experience, and that's their excuse for why they're going to exclude the roof, right? But going into, I felt like I had something to add to what you said. Well, I'll get going because I know time's creepy. But yeah, with roof, go ahead.
I know that in Florida right now, like last year, their government, the state passed something that said that they're wanting people when they sell a house to have a roof that's less than 15 years old. Even though they put on roofs that last 30 years, 40 years, or 50 years, there's something with the insurance thing in the state that they're requiring people to have roofs that are less than 15 years old. So some of the sellers are having to put on new roofs in order to satisfy this, close the escrow. Do you foresee something like that happening here?
Not here, and I'll tell you why that's happening in Florida, because Florida has hurricanes. That's the situation. A lot of big carriers like State Farmers really isn't in Florida. We have an auto line out there, but that's about it. A lot of big companies like State Farm, they're leaving Florida because of that. Hurricanes, right? So that's probably, I'm assuming, right? Just from what I know,
It's something ironic.
that's, yeah.
Why would you ever spend money to put a roof on that's 50 years?
Because tomorrow a hurricane hits and now the roof is the first thing that's going to be gone.
Roof is on the neighbor's roof.
Or if you
Yeah.
want to sell your house, you have to put on a roof, you can sell it, that's a.
Yeah, insurance, no joke. homeowner policies in Florida are about 3, 4, 5 times the cost of what they are here. Just because of that, to cover the hurricane.
I have to have a wind-driven water policy, which is also like hurricane. I have two in my workplace, I have a regular insurance. And I have different hurricane. So it's a different policy, an additional policy. But that's just the big one.
Yeah, exactly. what
Yeah,
I'm
kind of
saying.
like flood. I didn't know. It used to be built in.
Yeah, no, well, I think it is in different places, but in Florida, you have to have full policy. But the roof thing is something different. That's even, that was just through their legislature. Oh, no.
That might be a good option though. Yeah, there's so many damages happening with roofs. Roofs are like, the way I look at it, it's kind of like a used car, right? Over time, it's gonna leak oil, right? So that's a good reason why roofs need to be replaced, especially when they're the foundation of the house, really. Right? So okay, so I got two left. Mary has a rental property where she converted the detached garage into an ADU. Mary calls her insurance company and increases her separate structure limit on her landlord policy to cover the cost of the ADU. While cooking, the new tenant in the ADU causes a kitchen fire, which severely damages the structure. Will her policy cover the damage under the separate structure limit?
Separate structure is not
I
enough,
don't know.
Not
not
the
enough to
structure.
cover an ADU, right?
Let's say they up the limit. I said they up the limit on the separate structure to cover the cost of the ADU.
Oh, yes.
Okay, we have a yes, we have a no.
I don't think,
It's kind of a confusing question, right?
Wait, but she called her insurance agent and said, I've got an ADU, so increase
she
it.
didn't say that.
No, she
just
said she has a
structure.
separate structure. It's an attached garage, maybe.
Yeah.
Yeah, well, in this case, she did. She converted her garage.
But does the insurance company know that there's a kitchen in there?
It's an
Well, yeah, that's a
ADU.
good question. So that's why this is a good point, right? Because a lot of people are doing this.
Yeah.
The minute if it's a built guest house,
Like a separate
pool house,
structure.
yeah,
Yeah.
separate structure. It's a guest house. It's a pool house,
Or an ADU.
not an ADU.
Okay.
ADU now makes it, I guess it's its own address,
Okay.
right? That makes it a business entity at this point.
Okay.
That's the key difference. Anytime it's a separate structure, yes, it would be covered. However, the minute it's converted into an ADU, now it's a business entity. The minute it's a business entity, it's not covered. It would have to be covered separately like a secondary house.
So like example, I have a duplex and I have two policies. One for the property on Orange, one for the one right next door on Brookshire.
Correct.
So that's what would have to happen here.
Exactly. The minute you have the ADU, if it's detached to the home, yes, it has to be insured separately like a separate unit. Because now it is a separate unit. It's a completely
Yes.
separate exposure because you're using it as a business. You're renting the property.
If you have a
So
house,
if you lease it out, the person that, the tenant doesn't get the insurance.
You can force that's on your disclosure, right? Whether you can, I always recommend force all your tenants to carry renter's insurance, right? But you would still need to insure it separately. Because at the end of the day, if the fire happens, you're the property owner. You can't rely on them having renters. If it was legally converted into an actual ADU and it has its own address, then yes, it should be its own policy. Even if you have family living in it. There's even cases, right, where people build a separate structure to run their business from it, right? I learned this recently. If you build a separate unit that's not legal, but you're actually running your business out of it, that could be excluded under the separate structure limit. And it's important to understand separate structure. If you guys remember a few weeks ago, I talked about it, right? Because many homes in Downey do have guest house attached to the detached garage. And the way the separate structure limits are typically calculated, it's 10% of the structure A limit. Structure A meaning the main house. So if the main house is a 1,200 square foot home that can be rebuilt at $220,000, right? You're meaning that separate structure is only going to have a $22,000 limit. Most people that have guest houses, gazebos, even it can even extend to pools, right? Don't have enough separate structure limits. God forbid tomorrow fire happens. So always keep an eye on separate structure limits. Yeah, this is a good.
How about the kitchen part? Like, if it's, well, never mind. If an ADU was legally adequate.
Yeah, if it was a separate structure and she upped the limit, it was a guest house, then yeah, it would have been fine.
some families divide a house and make two houses out of one.
You have a
Illegal.
yeah, that I've seen that happen, and usually lawsuits turn in. I've seen big lawsuits arise there. Depending on who did it, right? If the homeowner did it, yeah, there's usually no coverage in that sense because the homeowner at that point is negligent, and he gets fined, and then that's considered uninhabitable residency. And I've seen homeowners have to pay back almost their on top of pain and suffering all the rents back to the person they collected rent. Yeah, it's a huge red flag. Don't do that. Yeah, I had a client that went through a real large lawsuit in that situation, and it was done by his dad. The dad did it, and he inherited the policy, but kept tenants like that. And I don't know what happened. I think he tried to evict one of them because he wanted to remodel it and whatnot, or change the place. And he got sued. Nasty. We partially assisted him in some of that lawsuit. All right, last one, right? Sally sells real estate part-time. During a list, or let's see, she trips in a customer's home while doing a listing presentation and falls into an 80-inch big screen TV,
Silly.
breaking it. How much will Sally Farmer's homeowner's policy pay to the homeowner for her negligence? The liability. So yeah, nothing. Only because she's doing, again, business use, right? She's being,
because she's doing business.
even if she was working part-time for Mary
So if I
Kay,
was- What if I was just there as a friend and I fell into the TV?
your
right?
homeowner, yeah, your liability would cover.
Oh,
The liability,
Will the homeowner insurance step in and stay?
no, if she was there because of a listing presentation, no. Typically, like, right, being a realtor, you're being self-employed. So there is actually GL policy, general liability policy. Then Allstate sells them for like $300 a year. That you could have in the event you're ever responsible for the damage of someone else's property while you're working. Okay, it's a key coverage. I usually recommend it to everyone to have, right? But in this case, it won't. But the reason why I still wanted to bring this up is because a lot of the times your liability on your policy is not just premise, it's also personal liability, and it's very extensive. So yeah, back to your example, you just are at a friend's house and you tripped over your friend and broke her 80-inch TV, it would be covered. And anytime there's a liability claim, there's no deductible needed to be paid. Like, I mean, depending on the carrier, some do have a 500. But let's say typically on your homeowner, there's no deductible on any med pay or any liability. Let's say I have 2 toddlers, right? They're running around at the mall. They got their hands on everything. They cause a lot of property damage at the mall. My homeowners would step in and cover that. Kid throws a rock through a window, right? It's anytime you or your family or household member are responsible for the physical damage of someone else or someone else's personal property. Now, an emotional loss, right? You would have to have an endorsement called personal injury, right? And what does that mean? You are now on Facebook trying to defamate someone's character, right? And you get sued for that. If you have personal injury endorsement on your homeowner, it would extend to such cases. Right?
This is what we've come
So
to.
I always add that. Personal injury is a great option to add. It's usually about $10-15 a year. It could add to some emotional losses, right? And businesses have to have something called EPLI, emotional practice liability insurance, right? And that's now for cases that, we're in a sensitive world. You get sued for discrimination or
And so what if you mean all this real estate agents should have that policy?
the
I mean,
EPLI.
honestly, think
E&O
about
is
it.
actually pretty good. You gotta just make sure the E&O has discrimination added to
You
it.
said
Some do.
emotional and whatever you said, but imagine somebody posts, okay, let me give you an example. I sell a house, I post the sale price on it, and the buyer gets emotional because he didn't want anybody to know his business.
But at that point, you gotta remember, in the court, they have to prove,
Mental distress.
yeah, distress and how that actually caused the loss to the person.
Okay.
It's a lot harder than you
But
think
we
to
could
get sued
post
for
something
defamation.
that unknowingly to us could cause an emotional stress on someone else.
Yeah,
You
today's
know, I
world,
mean,
yes.
people post all kinds of things on social media, videos of showing houses and stuff like that. But there's just a lot of extra stuff that we're doing that we never did before. And there's more people suing us for stupid stuff, like you just said, emotional distress.
Yeah.
So So on that example, if Sally went over, she has to have that special coverage, you said?
Yeah, she has to be
And what's it
insured.
called?
Or sometimes if you work for an office that has general liability, the general liability of the office could cover it.
Okay, but what's it called that Sally would have to have
It's just general liability.
on her own?
Yeah.
And so is that general liability, is that an umbrella, is it on her
So
car, is it
liab-
on her house?
It's a personal liability policy on herself for her products
herself.
completed, yeah.
How much does that, I mean, so if Sally's klutzy, she may. she
Yeah,
may
it's
wanna
not an
have-
E and O policy,
She may
remember,
wanna
because
have
this E and O
personal
wouldn't cover
liability.
this.
So how much does personal liability
Yeah.
cost, if I may ask?
That's, I mean, for like I said, a realtor, it's about $300 a year.
$300 a year.
Yeah, it's not expensive.
And how much coverage?
$1 million.
$1 million.
Very inexpensive. Just truthfully, a likelihood of something like
And for
this.
the
right?
emotional
So-
one, how much does that cost a year?
That's expensive. Yeah, the emotional one's a little more.
Then one
Typically,
last,
it's cheaper to buy it to be, you know.
one last question then. Sally went over to this house for a listing presentation, but they poured her some wine. And now, you know, they say they're friends. And then is that covered under the homeowner's policy?
Yeah, if she actually tripped, well,
I mean, she tripped. We're not saying she tripped. She definitely tripped. She broke the TV, but
She
the
was
homeowner,
plastered.
files a claim and says, my friend was over and
it's not a covered loss.
it's not covered in.
Yeah, it wouldn't be a covered loss. But it can omit now Sally's liability because the homeowner gave her wine. So if she now trips and falls on the stairs home and she sues the homeowner's liability would step in to protect her against that.
Sally dropped the bottle.
That's another very. It could go in now. It could really go into detail as far as who opened it and with what it was opened with. All right, guys. Thank you so much.
Thank you, Andy, so much.